A busy week on the economics calendar. Producer inflation figures out just a short while ago show the PPI rising by 9.4% last month. That's from 6.8% in May. Yesterday, consumer inflation numbers for June came in lower than expected, with the consumer price index rising by just 4.2%. And credit numbers out this morning show a tiny rise in credit demand from the private sector. Joining me to dissect the numbers is Chris Hart. He's investment strategist at Investment Solutions. Chris, PPI, quite a big number, 9.4%. Was that in the realm of what you were looking for?
No, we were looking more in the realm of between 7.5 and 8. And this is it's now been worse than expected now for a few months. And you've got two different stories now. You've got the inflation story, which is in the process of still moving down, better than expected, and produce inflation worse than expected. And effectively what that's telling us is that the turn in your inflation cycle is imminent. In other words, a 4.2% might be pretty close to the bottom, if not the bottom, and that it'll start trending up. Obviously, at 9.4, they're not measuring the same things, but you can appreciate that there's some inflationary pressures that are now coming through as far as the in terms of cost pressures, cost push inflation. And I think the governor of the Reserve Bank, Jill Marcus, did allude to that in her monetary policy review, in the sense that that is something that they're concerned of, and the producer numbers reflect that. But when you look at inflation itself, which is what they don't target producer inflation. That is a risk to inflation. But from a point of view inflation, and another risk to inflation is credit growth, you're still looking at a very benign situation as far as credit growth is concerned. And I suspect they'd be tempted to cut rates, especially with the strength of the rand. That will help to temper producer inflation in the months ahead. And also it'll temper consumer inflation, CPI. And so if the rand stays strong, with weak economic growth, weak credit growth, the external environment looking increasingly dodgy, they probably will cut in September.
Well, let's just go back to that CPI, because you said 4.2% could be near the turning point for CPI. Yeah. Do you think we're going to see increases as dramatic as we're seeing in the PPI baskets at the moment, or do you think it'll be a little more tempered?
It will be tempered. The producer inflation is a lot more volatile. It's your effectively the raw material cost, there's processing, etc. And the final product, there's a whole lot of things that get added to that, besides just the raw material costs, and so it tends to be less volatile at the end of the pipeline rather than at the beginning of the pipeline. So we'd expect it to be levelling off and starting to rise in the next few months. But again, staying within the target band at this stage for quite some time, as long as the rand remains reasonably controlled.
Of course, we had those electricity price increases already feeding through to producer inflation a couple of months ago. The next CPI reading is going to start including those hikes on a consumer level. Exactly. What sort of impact do you see that having?
Well, as I say, this is why 4.2% is unlikely, and that it may actually jump quite, to a level close to 5% in the next reading, depending on how much feed through there is in terms of knock-on effect and in terms of inflation. So so that's the concern that one would have, and that would be the big obstacle between now and the September meeting of the Reserve Bank, as to say whether they'll cut it. Obviously they'll say.
Of course, you said you're expecting a cut, despite the risks that we have from electricity.
Exactly, because they are looking forward, and at this stage with the rand where they are, I don't think inflation is it's very possible that inflation remains within the target band over the forecast horizon.
Of course, wage settlements, we have the public sector going on strike today, trying to push for an 8.6% wage increase. We've already seen Eskom getting quite a good wage increase, and across quite a number of sectors, increases well above inflation. This is also going to start feeding into that CPI going forward.
Yeah, absolutely. I think these wage increases don't. It's a very indirect link to inflation, but of course, government raises their service charges for a number of areas, you know, to accommodate this thing that needs higher taxes, etc. So it's not so great. The disappointing thing is, of course, we're going into a strike, you know, almost immediately, I suppose. There have been discussions, obviously, up until now. But the problem is after the World Cup, you know, we say, right, come and invest in the country, and of course the investors are greeted with hostile regulations, hostile unions, and the potential for higher taxes. It's not a great message.
Private sector credit demand, you mentioned that a little bit earlier, ticking up marginally from 0.8% to 0.9%.
Yeah.
And it looks like consumers are starting to borrow a little bit, but corporates aren't borrowing very much. Do you think it's because interest rates are still too high for them?
We're at the low of the interest rate cycle. There is no ways on earth that we can describe our interest rates as
But are
too
banks
high.
passing those interest rates through to corporates?
Yeah, the rate's accessible. The point is that that is the credit available. In other words, what is happening to the actual lending standards? That's the first thing. Are they still too tight? And are our corporates still too cautious? And that may be the...
It could be a combination of both of those.
Yeah.
Chris, we have to leave it there. Thank you very much for your insights today. That's Chris Hart, he's investment strategist at Investment Solutions.